2023 is rapidly coming to a close, and for most people, it'll be business as usual. However, those who are smart and savvy will use this time to revisit their investments to take advantage of some tax-saving strategies to reduce their taxes and grow their nest egg. I'm Chris Abts of Cornerstone Wealth Management, and you are watching Redefining Retirement, and this is where you can count on straightforward and objective advice on the toughest challenges you'll face in retirement today. Now, if you like the idea of reducing your taxes and growing your hard-earned savings, then today's show is just for you. We're going to look at 7 strategies that you can take advantage of before year-end to reduce your taxes this year, increase your nest egg, and make the most out of your IRA and 401k. As it turns out, there are many different strategies that you can take advantage of, but here's the deal, it's up to you. So either you can do nothing different than you did last year and just pay your taxes, or you can take advantage of some great strategies to save yourself a big chunk in tax and increase your life savings at the same time. So here's what's coming up. Now, a problem I see here is that the amount of risk that you were okay with many years ago, when you didn't have a lot of money, is probably not the same level of risk that you're okay with today. The longer that money stays inside that account and is allowed to grow without paying taxes, the larger the tax bill is going to be. Pretty simple. I am really excited about today's topic. So sit back and relax. Redefining Retirement starts right here, right now. Saving for retirement is a great start, but it's what you do with your money that really matters. Success in retirement, it comes down to reducing your taxes, generating your income, minimizing your risk, maximizing your Social Security, and more. Welcome to Redefining Retirement. I'm Chris Abts of Cornerstone Wealth Management, and this is where you can count on straightforward and objective advice on how to make the most of every dollar you've saved for retirement. Today, we're looking at 7 year-end strategies to reduce your taxes and to help you grow your nest egg. So strategy number 1, take advantage of tax-saving strategies now to save on taxes this year. With almost $34 trillion of debt and growing at the rate of almost $2 trillion a year, who doesn't think taxes will increase in the future? Yet tax planning is one of the most effective, yet all too often, overlooked areas of financial planning. A small investment of time to take advantage of some of these tax-saving strategies could result in big tax savings for you. The sooner you take advantage of these tax-saving strategies, the more options you have. Taxes will play a really big role in your retirement for 2 reasons. First, because you are the first generation to fully fund your own retirement. Today, most retirees fund their retirement not with a big pension, but with tax-deferred accounts like IRAs and 401ks. And second, we have almost $34 trillion of national debt. To put that into perspective, we now spend more on interest payments on the national debt than we do on defense spending. So obviously, today's low tax rates are not sustainable. Simply put, taxes are lower today than they've been for the past 40 years, and due to our growing debt, many economists and tax experts, they say that higher tax rates are inevitable. Fox News said if Congress does nothing, which is what they're pretty good at, pretty much every American will pay higher taxes. And those increasing tax rates, they begin just 2 years from now. So regardless of how much or how little you have, you can look forward to higher taxes in 2 years. This happens all the time when people come into our offices to help plan for their retirement. Many times, they're not thinking about their taxes. Instead, they're thinking, can I retire? Or they're thinking about their IRA or 401k. They're not thinking about how best to optimize their Social Security with their other income, like pension or real estate income, or how to plan for Medicare. Yet right now is an excellent time to take a look at your retirement tax strategy. So strategy number 1, make sure you have a tax-efficient strategy for your Social Security, your IRAs and 401ks, and any other investment income. And we can help you do this. Number 2, which works in conjunction with strategy number 1, right now could be a perfect time to convert your IRA to a Roth. Why? Because when you deposit money into your IRA or 401k, you get a tax deduction, which makes this a tax-free investment. Plus, all that money and all the earnings grows tax-free. But Those taxes aren't going away, you're just deferring them until later, when your account is much bigger. So the taxes are bigger. And in the future, when you start withdrawing that money, the taxes will be even bigger because the tax rates will likely be much worse in the future. One question we get a lot is, should I convert to a Roth? And if so, what's the best way for me to do that? That's a great question, and we can help you with that as well. And while the answer to that question depends on your specific situation, just remember that right now, today, taxes are at 40-year lows, but they're scheduled to increase just 2 years from now, which means you must act now. One thing you can do is check with your HR department to see if you have a Roth 401k option in your plan. If so, you should consider if it makes sense for you to put some of your contributions into that. Second, don't let anybody tell you that you can't put money into Roth because you make too much money. That's not true. Today, there are ways that you can move money from an IRA or 401k into a Roth, and we can help you do it. Now, if you converted your IRA or 401k into Roth, how much money could you save in taxes? Should you convert your entire IRA to Roth before the end of this year? Or should you do partial conversions over several years? I want you to learn how you can benefit from converting your IRA or 401k to a Roth with our free, customized Cornerstone Retirement Roth Conversion Analysis. Here's how this works, and it's really simple. Once we get some basic information from you, we'll run the numbers so that you can see the difference between keeping your IRA or 401k and what it looks like if you convert to a Roth, so that you have all the facts necessary to make a smart financial decision on what's best for you. And while many advisors charge hundreds of dollars for this analysis, we won't charge you a dime. Right now could literally be your best opportunity ever to convert to a Roth. So let's find out if it could save you a bundle in taxes. So give us a call to schedule your initial analysis. And coming up next, we'll take a look at 2 more strategies to help you pay less in tax and grow your nest egg. We'll be right back. Could your tax bill in retirement be larger than you think? Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. If you're like many savers, you may not know the total amount of taxes you could potentially pay. I believe information is critical to making informed decisions about retirement. If you agree, I want to share a resource that can help. Use your phone camera to scan this QR code. It will take you to a page that generates a quick report that can help evaluate your potential tax bill in retirement.
If you'd like more information about financial planning, industry news, and market updates, you can subscribe to our blog. Visit our website at cornerstoneway.com. The resource request box is located on the bottom right-hand corner of the homepage. There you can submit your information to subscribe to our blog.
Welcome back to Redefining Retirement, where you can count on straightforward and objective advice on how you can make your money go a lot further in retirement. I find it hard to believe, but 2024 is almost here. And for the remainder of this year, most people will be busy with all the things we do around this time of year. But for those that are wise and smart, they will find the time to take advantage of some year-end tax planning strategies that could really help them to pay less in tax and grow their nest egg as well. So today, we're looking at 7 year-end strategies to help you to pay less in tax and grow your nest egg. Now, before the break, we looked at the first, which are take advantage of tax-saving strategies right now before year-end, because this could be a perfect time to convert your traditional IRA or 401k to a Roth. And then coming up on this segment, we're going to look at a couple more strategies. Why taking the time to update and rebalance your portfolio should be a top priority, plus what you can do before year-end to get the most out of your IRA and 401k. You know, I want to tell you, during this time of year, here at Cornerstone, we are busy helping our clients take advantage of many of these year-end strategies. So here's strategy number 3. Review and rebalance your portfolio to bring your risk exposure in line with your risk tolerance, your risk comfort level. See, now is a great time to take a look at your portfolio, especially if it's been a while. You know, many times when people come into our offices for the first time, they have this stack of investment statements that they brought with them. It's basically what they have accumulated over the years. And it's very common to hear that they don't really understand how their various accounts and investments are supposed to work together. And almost every time, they find that they're taking far more risks than they need to or that they want to, simply because they don't understand how everything works together. So the questions that you should be asking would be, hey, how long has it been since you updated your portfolio? When was the last time you identified the amount of risk you're taking with your investments? The truth is, most people haven't updated their portfolio since they opened their 401k many years ago. They just set it and forget it. Very common. Now, a problem I see here is that the amount of risk that you were okay with many years ago, when you didn't have a lot of money, is probably not the same level of risk that you're okay with today as your account balances have grown and as you get closer to retirement, as you get closer to needing to withdraw that money in retirement. But unfortunately, it's all too common that they haven't changed anything. And now, as they're getting closer to or maybe in a retirement, maybe they're already retired, that their portfolio and their risk tolerance looks a lot different today at, say, age 60 than maybe it did at age, say, 35 or 40 when they were, adding to the beginning to add to that account. Now, I'm sure you remember taking a big loss in 2000. I bet you remember taking a big loss in 2008, and the list goes on. And the closer you are to reaching your retirement goals, the less loss you can afford or want to actually experience another major loss. And this is what's referred to as the sequence of returns risk. Now, we talked about this many times before on this show. It's sequence of return risk. It simply refers to how the order and the timing of bad investment returns can have a massive impact on how long your retirement savings will last. So here's an example. If you lose, say, 20 or 30% of your portfolio, it will have a massive impact on how long your money will last. And unfortunately, many people don't give this the respect it deserves as they're withdrawing money from their portfolio in retirement. Folks, the fastest way to destroy a retirement is to experience a loss and then taking withdrawals as you're trying to recover from that loss. So here's an example I've shared with you before. Let's imagine we have two brothers. They both retire with the same amount of money, and they both take the same amount of withdrawals. The only difference is the year they retired. The first brother, he retired in the year 2000. After 10 years, he was almost out of money. Why? Because we experienced a couple different periods of time where there were losses. The other brother retired in 2010. After 10 years, not only did he take his income, but his account was more than double in size. Why? Because that was a time when the market was just going up. So the only difference here was the year they retired. That's the phenomenon known as sequence of return risk. Everything being the same, but the market providing the impact. So folks, you don't want to leave your retirement to chance. You want to have a plan. You want to have a strategy when it comes to the risk you're taking. This is why you want to properly rebalance your portfolio, especially as you get closer to retirement. Yahoo Finance, they recently did an article titled, "Why Rebalancing Your Portfolio is More Important Than Ever Right Now." They say it's not about growth, it's about security. It's about protecting the money you worked so hard to save and accumulate. They say if you're nearing retirement, that you're at a particularly big risk right now, and that you should take a hard look at your asset mix, especially if it's been a while since you've rebalanced. All right, let's take a look at strategy number 4. Maximize your retirement account contributions before year end. If you consistently max out your retirement savings for, say, a couple decades, you could end up retiring with a whole lot more money than you planned on. CNBC says that for the average investor, one of the best ways to reduce current and future tax liability is to contribute the maximum amount to a retirement account each and every year. Now, the good news is that it's not too late. You still have time. And if you were, say, 50 years of age or older, you can contribute even more due to those catch-up contribution limits. However, if you're unable to max out your contributions, then at a minimum, I want you to at least put in enough to make sure that you're getting the full employer match. Now, here's what typically happens. People set up their 401k contributions and then they don't make any adjustments to it. So here's an example. Maybe you're adding 3% and your employer was matching that with another 3%. That's a total of 6% into your 401k. Then before you know it, a few years pass and you're not taking full advantage of putting in as much money as you possibly can into those accounts. Now personally, I believe you should consider starting with the Roth, but that depends on your unique situation. And while you'll pay the tax today using a Roth, all that growth will be completely tax-free. And as a result, your future withdrawals will be tax-free. And it won't count towards your provisional income, so then your Social Security benefits can also be tax-free. And then your Medicare premiums would be lower, and it just continues to snowball in a positive way. Now, 401k contribution limits, they increased $2,000 this year. They'll increase again next year. So did you increase your contributions to match it? Now, this might seem like simple little things, but they can really add up to be a whole lot more money in your retirement if you take advantage of them right now, today. It all really comes down to making sure that you're doing the right things at the right time in the right way. So don't just watch my show. I want you to take advantage of these things to get the most out of 2023. Now, when you look at your IRA or your 401k account balance, it's natural for you to think of this as your money. That's what people do. But folks, it's not your money. Your IRA or your 401k, it's a joint account between you and the IRS. And over time, the size of your account, it will grow due to the money that you're putting into it and growth from the market. And the IRS, they're going to get their share when you begin to withdraw money from that account. And the way our tax system works is like this. The more you have, the more tax you will pay. Pretty simple. So that means you could end up paying a whole lot more in tax in your retirement than you think. So that's why we put something together for you today. I want you to learn how you could dramatically reduce your taxes in your IRA or 401k with a Cornerstone Retirement Tax Savings Analysis. So let me explain how this works. First, we'll get some basic information from you. We'll determine the tax saving strategies that are best suited for your specific situation. Then we'll sit down and we'll share with you exactly how much money you could save all through your retirement years. Now, we typically work with families who have saved at least $500,000 to several $1 million for retirement. But if you've saved at least $250,000 for your retirement, give us a call to schedule your free analysis right now. And when we come back, we're gonna take a look at why planning for those required minimum distributions, why that could save you a fortune in taxes in retirement, plus 2 powerful tax saving strategies called tax loss harvesting and charitable contributions. We'll be right back.
At Cornerstone, we believe you should be able to enjoy the retirement you have always wanted. To help you see your retirement strategy from all angles, we created a retirement roadmap, which is designed to help you discover the knowledge you need to take control of your money and live a confident retirement regardless of what challenges arise. So you envision the life you want to live, and we can help you create a plan that leads you down that path. Join us for a conversation about your vision for your ideal retirement by calling the trusted professionals at Cornerstone.
Welcome back to Redefining Retirement, where you can count on straightforward and objective advice on how you can make the most out of every dollar you save for retirement. I'm your host, Chris Abts from Cornerstone Wealth Management, and today we're looking at 7 year-end strategies for 2023 to help you to reduce your taxes, grow your savings, and get the most out of your IRA and 401k. Now, as a quick recap, strategy number 1, that's to take advantage of tax planning strategies now to save on taxes in this year. Strategy number 2, consider converting your IRA or 401k to a Roth. Number 3, it's to review and rebalance your portfolio to bring your risk exposure in line with your risk tolerance. Strategy number 4, maximize your retirement account contributions before year end. And because taxes are what I like to call the needle mover in retirement, In this section, we're going to look at why planning for required minimum distributions, why that could save you a boatload of taxes in retirement, plus a couple strategies to help you to pay less in tax called tax loss harvesting and charitable giving. But I want you to keep in mind that these must be done before December 31 in order to take advantage of them. So, strategy number 5, have a plan for how you will take your required minimum distributions. So if you're like most Americans, you're probably saving money in those tax-deferred retirement accounts. So the things like 401ks, IRAs, and you're probably thinking incorrectly that all of that money belongs to you. Unfortunately, once you turn 73, the IRS will force you to begin those mandatory distributions. And since you haven't paid tax on any of that money, the IRS is going to make sure that it gets its share of not only the money you deposited into those accounts, but a share of all of those gains as well. And the more you have in those accounts, the more tax you get to pay. That's just how our tax system works. And you're required to take those distributions whether the market is up or if it's down. You don't have a choice. Because if you don't take those mandatory distributions, the penalty, it's 25% on the amount you didn't take, plus the income tax liability on top of that. That's a big amount. In addition, the Secure Act 2.0 that was recently passed, it gradually increases the mandatory distribution from age 73 to age 75. Now, while you might think that's a good thing, for the vast majority of retirees, it's not a good thing. For example, the longer that money stays inside that account and is allowed to grow without paying taxes, the larger the tax bill is going to be. Pretty simple. Now here at Cornerstone, one of the things we do is to help people to take advantage of strategies so they don't have to worry about those required minimum distributions. And as it turns out, there are a number of strategies you can use to incorporate successful required minimum distributions into your retirement planning. But you need to do the homework. This is not something that you should put off and wait until you're 73 to start doing. Don't do that. I highly recommend that we start the planning way in advance. You see, if you can start early and have a plan for how and when that you will take those required minimum distributions, you can begin to coordinate things like your Social Security benefits, your Medicare planning, things like that as efficiently as possible in conjunction with your RMD planning, where you in effect can literally save tens of thousands of dollars in your retirement planning. Now, many times when people come into our offices, they say things like, hey, I try to do this myself and I'm confused. I've got this 401k over here. I've got this pension over there. I've got this IRA sitting over there. Then I've got my Social Security benefits. I've got my required minimum distributions. And everywhere I turn, I hear different advice. And then perhaps a parent passes away. And now you're dealing with the required minimum distributions from your parents' accounts as well. So it just gets complicated and confusing. But we can help you to simplify it. We can help you to sort it all out so you can make the best decisions for your retirement. All right, let's move on to the next strategy, number 6, tax loss harvesting. This is when you offset a taxable gain by selling something at a loss. We've experienced quite a bit of volatility this year, and as a result, you may have some taxable gains inside your account this year. And by looking at your portfolio, you may find that you have some stocks in your portfolio that are currently showing a loss. So you can lower your tax bill by offsetting those taxable gains by selling some investments at a loss. So this is a great strategy to help you to save some money in tax, as well as get rid of some of those losers in your portfolio at the same time. Now, to take advantage of the strategy, it's important to understand the difference between short-term gains and losses and long-term gains and losses because they're taxed differently. So the key is to offset those long-term gains with long-term losses and then offset short-term gains with short-term losses. So here's an example. If you owned an investment for less than a year before selling it, you will owe income tax on that gain. Now, on the other hand, if you held that investment for more than a year before selling it, you would pay the long-term capital gain tax rate, which is a better rate, and that's anywhere from 0% to as high as 20%, and it depends on your specific situation, and we can help you to do this correctly. Now, one of the nice things about working with a professional is that they have the records and they can help you to correctly offset your gains with any losses in your portfolio. Now, one of the things to avoid with tax loss harvesting is what's known as the wash sale rule. And that prevents a loss from being taken if a substantially identical one is then purchased within the same 30 days. So regardless, to take advantage of this strategy, all sales must be finalized before the end of the year. All right, let's move on to the next strategy, number 7, and that is consider charitable contributions to lower your taxable income. Now, most people think that if they donate to charity, assuming they're able to itemize, that they can take a deduction. That is true, but there may be a better option to consider, and it's something called charitable tax credits. So there is a difference between charitable tax deductions and charitable tax credits. Now, tax deductions, they reduce how much of your income is subject to tax. So here's an example. If you're in the 22% tax bracket, a $1,000 deduction saves you $220 in tax. On the other hand, a tax credit lowers the tax you owe dollar for dollar. So using the same example, a $1,000 tax credit saves you $1,000 in tax, meaning a whole lot more tax savings. Now, while there are many ways to create tax credits, a really simple method is with a qualified charitable deduction. That's known as a QCD. Now, I especially like this one, and we use this with our clients a lot. This is when you make a charitable deduction directly from your IRA. So if you're at required minimum distribution age, you can send money to the charity directly from your IRA. And based on what's happening in the economy and the stock market today, trying to protect and grow your nest egg today, it comes with a lot of risk. But we are here to help. So if you've saved and if you've invested for retirement, that's great. But at the end of the day, that's nothing more than a portfolio of investments. It is not a financial game plan. See, a financial game plan asks things like, how will you reduce your taxes? How will you grow your savings? How will you get the most out of your IRA and 401k? These are just a few of the critical issues we've been looking at today. And before you can even think about retiring, this is something you need to have in place. So we want to do something special for you today. We will create a comprehensive game plan for you, and we won't charge you a dime. This is not a one-size-fits-all plan. It's customized specifically for you and addresses the biggest issues with things like taxes, income, Social Security, healthcare, IRA and 401k withdrawals, portfolio risk, and the list goes on. Now keep in mind that many financial advisors will charge thousands of dollars for a customized plan like this, but we won't charge you a dime. So if you saved at least $250,000 for your retirement, give us a call. Folks, this could be the single most important tool that you use for retirement that could help you make the most out of every dollar you've saved. You know, we've helped thousands to retire successfully. Maybe we can help you as well. That's our show, and I hope you enjoyed it. I look forward to seeing you next week.
Jolly good show.